Welcome, everybody, to the Baker Institute here in Houston. I'm Jim Crane, and I cover energy and geopolitics for the Center for Energy Studies. And today we are going to talk about one of my favorite parts of the world, the Persian Gulf countries. And unfortunately, of late, things have been a little tough in the Gulf. The twin crises of the coronavirus pandemic and climate change have been like a 1-2 punch for these countries and really for all oil-dependent countries. We've seen the coronavirus demolishing short-term oil demand by curtailing travel. And then over the longer term, the threat of climate change has been looming, pushing all of us to use less oil, which just happens to be the main export from the Gulf region. And the main source of funds for government budgets, roughly between 70 and 80% of government budget revenues. So no part of the world really faces more economic damages from these two crises than the oil-based economies around the Persian Gulf. And we'll be talking about the GCC countries, the 6 Gulf monarchies. So that's Saudi Arabia, the UAE, Kuwait, Qatar, Oman, and Bahrain. And also probably get a bit into Iraq, and maybe even touch on Iran a bit. So the oil and gas revenues that really dominate their economies also provide the political grease that keeps these autocratic or mostly autocratic regimes in power. We're going to ask here, how are these Gulf countries coping with these two challenges to the oil business? That's our topic for today. So to talk us through these issues, we've got 2 preeminent experts whose job it is every day, day in, day out, to focus in on the Gulf economies. And both are joining us from Dubai. We've got Dr. Ziad Daoud, who's the Chief Emerging Markets Economist for Bloomberg Economics. And prior to joining Bloomberg in 2017, Ziad was the head of economics at the QNB Group, the Qatar National Bank Group, leading a team producing analysis on the Middle East as well as on the global economy. He holds a PhD in economics from the London School of Economics and a bachelor's in economics and statistics from University College London. And then we've got also Tariq Fadlallah, the Chief Executive Officer of Nomura Asset Management Middle East. Tariq has more than 30 years experience in international capital markets, including 20 years focused on the Middle East. He's worked in a number of key roles, including equity sales, research, and as head of investment banking in Saudi Arabia. And Tariq also went to LSE, where he got his bachelor's in economics. And he's also a chartered financial analyst. And unfortunately, for those of you who've been following this, we were to have a third guest today, Monica Malik of the Abu Dhabi Commercial Bank. But unfortunately, Monica's had a family tragedy and is unable to join us. So our thoughts are with her, and we hope to have her on another webinar in the future. So with that, I will back up here and hand it over to Ziad and for a short opening statement, and then we'll have Tariq also, make short opening statements, and then we'll get into our conversation. Ziad.
Thank you, Jim. Thank you for the invitation. It's a pleasure to be here and to be on this panel with you and with Tariq. What I want to talk about in my brief opening statement is basically 3 things. I want to talk about the state of GCC economies before the pandemic hit this year. I want to talk about the short-term impact of the pandemic here and now. And I want to talk about, lastly, about the shape of the subsequent recovery from the pandemic. So let me begin with the first point, the state of GCC economies before 2020. I think it's fair to say that the growth model of the GCC was basically hitting its limits even before the pandemic hit. If you think about how economies grow, they grow through 3 things. One, they could employ more people to work. Second, and third, they could combine the same amount of capital and labor more efficiently to produce more output through productivity improvement and technological improvement. And if you decompose GCC historical growth along these 3 dimensions, and we did this for Saudi Arabia, but the picture looks similar across other countries, you see that most of the historical growth over the past 2 decades came from the accumulation of labor and capital. And that productivity has been a drag on growth. It's been negative. It's been declining every year. And that's problematic in any country, but it's particularly problematic in the GCC, because the growth of labor and capital was funded by oil money. So when oil was $100 per barrel, governments and other institutions were increasing their investment spending, and that led to a large accumulation of capital stock. The GCC was also attracting a large number of foreign workers, and that increased the pool of labor, and that generated growth despite the drag from productivity. But as oil money started to dry up in 2014, we saw that this accumulation of capital and labor started slowing. Productivity was still negative, productivity growth was still negative, and therefore you have this problem in the sense that you can't generate growth because your normal factors that generate growth were slowing. So that was the state of things before the COVID-19 shock. What the pandemic did is that it amplified these forces. What it did two things. First thing it did to the GCC, what it did to any other country, it paralyzed economic activity. Growth in the second quarter of the year faced a massive slump. We have GDP statistics now. They show that the decline was about 8 to 9% compared to a year earlier. But that was not the end of it. It also depressed oil prices through depressing demand. And what that did is it basically tied government's hands from injecting a stimulus into the economy in order to ensure a recovery once lockdown measures are eased and once restrictions on movements have been removed. So the state of the economy currently is it faced a massive slump in the second quarter, but because of the decline in oil prices, the subsequent recovery is likely to be limited. Now, how about going forward? What is the path going forward? We hear about different shapes of the recovery: V-shape, U-shape. People even talk about K-shaped recoveries, where you have uneven rebounds across different groups of people or different sectors. I think the relevant shape for the GCC is an L-shaped sort of growth, where the growth would drop permanently to a lower level. And we have seen that happen recently. We saw that happen in 2014 when oil prices dropped. We saw non-oil activity in the GCC, which is the main gauge for economic performance, dropped to a third of the previous rate. So before 2014, non-oil growth was about 6-point-something%. Post 2014, that dropped to 2.25%. And if you think that oil price drop in 2014 was painful enough, it's likely to be even painful now. Why? Because the GCC economies are weaker today than they were 6 years ago. So if you look at the different metrics of how you measure the economy, the budget balance, the current account balance, reserves, non-oil growth, debt, external and public, on all these metrics, on every single individual metrics, the GCC on aggregate is weaker today than it was 6 years ago. And if the oil shock was painful 6 years ago, it's also likely to be painful now. So to wrap up, I think there has been a recognition even among policymakers, that's why we had lots of visions and strategies and so on, among analysts and observers of the GCC, that the growth model was unsustainable. Technology was going to challenge that, and a model that is funded on oil and reliant on higher oil prices was always going to be challenged by technological advances and by climate change concerns. I think what we've learned from the 2014 and the 2020 shocks is that these concerns are not distant prospects. They are more imminent than we had previously thought. And I think barring change to the dynamic and an overhaul of the structure of the GCC economies, I think the pandemic shock could have a longer lasting effect than we currently anticipate. So on this note, I'll stop and hand over to you, Jim.
Okay, well, there's a really interesting, tough look at the GCC economic model there. So why don't we hand over to Tarek? I see your slides are loaded. So Tarek, the floor is yours.
Great, thank you, Jim, and thank you for the invitation. It's great to be on here with Ziad. I just want to follow on from Ziad's point that this has been really a very big shock to the macroeconomy. We see here is that the chart that I put up, the question that's asked, Saudi, is it insulated or in denial? And that is in reference to how the stock market has reacted to this economic shock, if you like. And what you can see is that Saudi Arabia, the TASI index, the Tadawul index, is up around 2% this year. And that belies the kind of economic shock that Ziad spoke about earlier. But you can see that in other parts of the GCC, the stock markets have behaved much as you might expect it to behave. And Dubai is a case in point. Dubai clearly, as the most open and diversified economy in the region, has been very, very open to the threats that are being caused by the coronavirus, specifically travel, tourism, aviation, hospitality, all sectors that have been hit very hard. But beyond that, you can see the stock market in Saudi Arabia has done well, not because earnings have gone up, but because valuations have increased significantly. And that is shown by the graph on the left-hand side of the slide. You can see that PE multiples have expanded so much that we're now threatening the levels that we saw all the way back in 2005, 2006. And for this to make sense and to justify the premiums that we see in valuations, both against the MSCI, for example, the emerging markets, that shows that you've got to have a significant rebound in profitability, which currently doesn't look likely. If I move on to the next slide, you can see what that means, both in terms of the relevance to oil and the budget balances in the GCC. Again, Ziad touched upon how important oil is to the region. What you see here is that historically there's been a very close correlation between the oil price and the stock market, which is exactly what you would expect. Now, bear in mind that the oil price back in 2017 and 18 was also on much higher export volumes that we see today. And yet, despite the dip in exports and the 30% fall in prices compared to last year, the stock market has continued to rebound. And on the right-hand side, you can see how that doesn't tally up necessarily with the financial or the fiscal outlook, I should say. And the data here shows the individual country breakdowns for the GCC countries, and it looks particularly ominous for Kuwait and for Oman. And then finally, to sort of touch upon something which I think we will discuss later on in this webinar, we look at the performance of oil and how that's being impacted by the threat to oil that we see from renewable energy and from the electrification of the vehicle fleet. And although I have the numbers here for the 1 year and 5 year change in the performance of oil relative to the overall world index, in fact, you can go back and 6 or 7 years to identify the point in 2013 where oil started to deviate from the rest of the market. So this is not a 1 year story. This is not a 5 year story. This is really a secular trend that has been in existence for some time, and which, in my opinion, is likely to continue into the indefinite future. Thank you.
Jim, you're on mute, I think.
Sorry about that. You can hear me? Well, great stuff, both of you guys. A little bit bracing analysis of a part of the world that we're used to seeing growing particularly quickly. So some trends there that are looking pretty tough, and some potential overvaluations in the stock market. I have my list of questions, but before I get to that, Tariq, could I just ask you on your presentation, the Tadawul's, sort of what you're presenting as maybe an overvaluation of shares on the Tadawul in Saudi Arabia. Is that a factor of the Aramco IPO? And what does that say about the Aramco valuation?
Well, I think it points to two things. One is there's actually an abundance of cash in the local economy, at least for the time being, and so that's being pulled into the stock market. And Aramco certainly has been an anchor for the market. So you saw the numbers there on the performance of the global oil indices. The likes of Exxon, as you know, have done very poorly recently. Aramco, which listed almost a year ago, is up about 10% from the IPO price, despite everything that has transpired over the last 12 months. So it's pretty extraordinary. And whether that is a positive signal or a concerning signal is really a matter for debate.
Well, it's not based on earnings, then, I guess. But it's interesting. So so let me get to a couple of questions. So I wanted to start out by just talking a little bit, or getting into the pandemic in the Gulf, how it's played out there, and the government response. We've heard about some really high rates of infection, and I think in Qatar for a while was among the highest in the world in terms of infection rates. Some really strict lockdowns being imposed, and some really high rates of testing that we heard about. So I wanted to start with Ziad and ask how's the coronavirus pandemic affected life in the Gulf? Has it been as deadly there as elsewhere? I think the population skews younger in the Gulf, so maybe that has been a factor. And maybe should talk a little bit about the economic effects, especially on the tourism economy, et cetera.
Sure. So much like the rest of the world, the pandemic hit here. There were strict lockdown measures that were imposed here. In terms of deadliness of the virus, I think there's two things here. One is you have a lot of testing here. It's more straightforward to test here than elsewhere. From personal experience, I tested here, I tested in the UK. It's a far more streamlined experience to do it here in Dubai, much faster, much quicker, much more efficient than elsewhere. But I think in terms of the fatality, it hasn't been quite fatal. So I think if you look at the number of deaths per case, it's actually relatively low here. It's about 1% lower in some places, slightly higher in others across the GCC. And I think that reflects the fact there's a lot of testing. That reflects, as you said, the demographics, that the population is generally younger than elsewhere. That might also reflect the fact that the climate is warmer. It might reflect the fact that the population is smaller and it's easier to contain a pandemic in a small population. And that might also reflect the fact that testing and health services might be better than in other places. So certainly the fatality rate is lower than other places around the world. In terms of the economic impact of the virus, I think there's a couple of things, as I mentioned. There's a direct impact that we saw, and that's fading now with lockdown. And that's basically paralyzed economic activity. People were not buying, were working from home if they can. The commute was less, and that obviously led to a sudden stop in economic activity. That was temporary. It has ended. We will see if we're going to get a second outbreak and further lockdowns. But the more permanent thing is the impact of oil prices, because that means even once these measures are eased and they're relaxed, the takeoff is not going to be as rapid as in other places where you had sizable stimulus measures, where you had the government stepping in to compensate workers for the lost income, to compensate businesses for the lost revenue. And I think that makes the recovery faster, and that we haven't seen here.
They just won't have those oil rents to be able to spend to do that, right?
Yeah, obviously that's a factor. So they faced a trade-off between, we have an uncertain virus. We don't know how long it lasts for. Some countries have deep pockets, but the deep pockets are not infinite. And therefore you want to be cautious in how you spend your savings. But also you want to, step in and help the economy and make sure that the temporary damage from the virus, the ones that last, for 3-6 months, doesn't turn into a permanent damage if companies go under or people, foreign workers leave. And I think they erred on the side of trying to be cautious rather than support the economy.
Yes, I think that was one of the things that Tarek, you mentioned in your recent brief that you sent. how the government has revenue streams have been affected and how the fiscal response has been a little bit restrained, I think. So I'm wondering if you could maybe talk a little bit about that and also about the reopening. I mean, I know there was a pretty strict lockdown and that's being eased, especially in Dubai, but maybe, what's the reopening, situation looking like around the region?
So I think the reopening is going reasonably well. If I look at Dubai, for example, the activity around town has definitely picked up over the last couple of months. But it also varies from country to country. So Dubai, by its very nature, is much more transient and open to tourism and travel. And so you continue to have a good flow of traffic from other countries. Other GCC countries are more insulated. Saudi Arabia has been pretty cautious about opening its borders. It's managed to contain the virus, I think, better than others, but it's also managed to capture a lot of the spending that might otherwise have gone overseas during the summer vacation period, for example. And you're correct to say that the spending, the fiscal response to the coronavirus has been somewhat lower than elsewhere. So we saw, for example, in the US, the government wrote out some pretty big checks. Also in the UK, the furlough schemes, and in Europe, the furlough schemes have been relatively effective. We've not seen that to the same extent in this region, and that's definitely impacted the economic situation. I think in countries where the government has a higher proportion of workers in the civil service or in the public service, like Saudi Arabia and like Kuwait, they have been relatively more insulated. So you can see recently, for example, the IMF actually revised up its forecast for GDP growth in Saudi Arabia from -6 to -5 or thereabouts. So it's been sort of a positive surprise, if you like, and that's because of this kind of insular nature of the economy.
Interesting. What about so I've been hearing a little bit about the in Dubai, right? It's always you always hear about these move to e-government and trying to get red tape out of the system. I thought it was pretty ingenious, the system of police permits, but to go out during the lockdown period. But I didn't have to live through it, so I just kind of wondered from your either one of you guys, how was it to when you wanted to go out to the grocery store or to walk your dog or to get some exercise, you had to get you had to actually log on and get a permit?
Sure, yeah. Basically, so during I think it was 2 or 3 weeks of lockdown in April. Yes, if you needed to leave, you needed to log into the website and ask for a permit. So you specify where you're going from, where to, what time, and I think you got 2 hours. And it wasn't for just this was for essentially for grocery shopping. It wasn't for exercise or anything.
Oh, really?
Yeah. So you do use it. You would use it every day. You'd use it every few days, and that basically it worked in a sense.
And so if security, police, asked you what you were doing, you'd show them your permit on your phone, and they did, okay, you got 15 more minutes, hurry up and get home. Was there a public backlash at all about this, or was it fairly innocuous?
No, it's fairly innocuous. I think people stuck to it, and that was it. I didn't venture very, very far out, so I got to the supermarket, which is literally 2 minutes downstairs. So yeah, it's very straightforward.
Great. Yeah, I'm not sure that would go down so well in the U.S., but I guess that's another topic. To our audience members, we'll be taking questions from you. So please use the Q&A to send in your questions, and I'll try and parse them out and get them to Tariq and to Ziad. I want to turn a look at oil and OPEC for a little bit here. So we've seen global oil demand falling 9 or 10 million barrels a day due to the virus. Wanted to hear about how that has played out in the GCC and with OPEC. I mean, it seems like, OPEC went, it's kind of in, oscillating in two major different directions. We first had this Saudi-Russia price war that was disastrous, with Saudi cranking up oil production to new record levels, and then reining that in May. And then since then, OPEC seems to be holding the line, and prices have been relatively stable. We saw them ease back on their cuts a little bit, and I think they're planning on easing back again in January. And this kind of new zero tolerance policy around cheating on production quotas has been interesting. I find it hard to believe that countries, the governments are actually paying compensation in terms of extra cuts, for cheating in the past. So I don't know. I was wondering if you could, maybe Tarek, if you'd like to weigh in, and Ziad, if you also have anything to say on this. How's oil doing with the in the Gulf?
Well, I mean, there's two ways of looking at it. One is that to say that the performance of oil has been disappointing. If you look at the last 12 months, almost every asset class, almost every commodity has gone up. Even things like esoteric assets like Bitcoin or gold or lumber, for that matter. And oil's down 30%. So that's the negative way of looking at it. The positive spin, if you like, is that it's obviously a commodity that's sensitive to the global economy, and demand is definitely down sharply. And so the fact that the supply has been relatively well disciplined is kind of a positive point from the producer perspective. My concern is that the longer this pandemic goes on, and we clearly don't see an end to it as of today, the more likely it is that we are going to see cheating. And that's simply because the OPEC members mostly are highly dependent on oil as a source of revenue. And clearly, the fiscal situation is becoming increasingly dire for many of them. So it would be difficult to imagine that the compliance levels can be maintained so strictly the longer that this pandemic goes on.
I always find it remarkable that they can maintain these quotas as long as they have. I mean, you've got, essentially 24 countries, really attacking this as a kind of a collective action problem and succeeding. I mean, I just find it, you don't see this in other international organizations, the countries taking individual sacrifices for the good of the group, so I always find it remarkable. Ziad, any thoughts on it?
Yeah, I think if you assess these massive cuts by OPEC plus the 10 million barrels a day, I think if you assess it, prices have doubled. No country has cut its production in half. And if you think in success in terms of how much revenue have you gained or lost, then obviously what you've gained on the price more than compensate for the losses on the volumes. But I think if you look, so that's on the short term, you're getting a short-term gain. My concern is this. My concern is that OPEC Plus has been doing this for the last 5 years. You get a demand shock, they all respond by cutting. You get this short-term boost to prices, something happens, shifts prices lower, you get the cut. So if you look at the secular sort of production of OPEC, I think OPEC used to produce something like 34 million barrels per day in 2016. Even before the massive cuts in early 2020, that dropped to 30 million barrels per day. So you had the secular decline, this loss in market share, because it was responding to the slow demand from the trade wars in 2019 and from Chinese slowdown in 2015 and 16 and so on. So my concern is OPEC Plus is succeeding in getting this short-term gain, but at the expense of a long-term pain. If you think about it, OPEC Plus has probably a cost advantage over other conventional oil producers. And I think if you think about it, ultimately, if oil prices decline because of technology or because climate or because something else, then OPEC would be, some members of OPEC, the ones with low cost production, will probably be the last people standing. And if they think about it, it might be worthwhile at some point to enter a price war whatever you lose on the price side, you gain on the market share side. But I don't know when that is going to happen. But we're seeing that tension every now and then. And I know people where you are, Jim, might not be happy with this. But this is the tension that we're seeing. This is why we're getting this oscillation between an outright price war and then this massive compliance and massive cartel action to contain output.
I think we in Texas are pretty unabashed free riders on OPEC cuts. I think that's been finally acknowledged here. So we like it when OPEC cuts. It gives the city of Houston a fillip, and the entire state. I mean, this is something I wanted to get into under the sort of the climate discussion. Is going forward, what's the oil output strategy going to be for a low cost, and by the way, a low carbon producer like Saudi Aramco? I mean, we're seeing them now touting themselves as this, as you put it, the producer of last resort, or the last man standing. I think former oil minister Khalid Al-Fallah said it. Put words to that to an interview with the FT, saying we're going to be the country that produces the last drop of oil, right? So and based on low costs, right? So their lifting plus capital costs are somewhere under $8 a barrel, and what turns out to be the lowest upstream carbon footprint in the world, right? So their carbon intensity of their oil is rock bottom, which is a pretty strong argument, an economic argument, an environmental argument for doing that, but for them to. And I guess if you follow on that argument, for them to be cutting to let higher cost and higher carbon producers in on a market that's being challenged by climate change doesn't make a lot of sense, right? So I think they do have a pretty strong argument for this market share strategy. It just may not be a strong economic argument at certain times, right? I mean, but if you think about it in terms of, do they want to see their natural resources stranded, or do they want to bring, get that stuff to market, if they're worried about it? I don't know. Any thoughts on how they might, if there's a strategy there for the Saudis at least, Tariq?
Well, I think Aramco has really placed its bets on SABIC. As you know, they've acquired a large stake in SABIC from the PIF. And so they've essentially made their bet. Other private oil companies, we've seen the likes of Shell and BP, have pivoted towards renewable energy. Aramco has some of that, and the kingdom more generally is trying to play a role in developing renewable energy, particularly solar energy. But Aramco as a company, and Saudi as a hydrocarbon producing country, has kind of placed its bets on being able to utilize oil in order to develop petrochemical products. So I think that's the way that they've decided to play it. And given their commitment to pay out dividends, fairly aggressive dividends as well, it makes it difficult to imagine what else they could do to diversify away from this high concentration on oil and petrochemicals.
Well, it seems to me that going into petrochemicals is a smart move anyhow, right? So it's a non-combustion use for crude, although there's emissions on for the industrial heat that you need, but that can be decarbonized. But also, when you're making petrochemical, you create these these resins and polymers that right now I think the kingdom is exporting those, but they can be used inside the kingdom to create jobs, to create a manufacturing sector around that, right? In plastic. So it would seem to be, a good diversification strategy anyhow that would meet a few goals. Ziad, did you want to chime in on this, or maybe on how that might square with the Vision 2030? We've gotten a couple of questions on some of these vision programs.
Sure. I think I'd say one thing on petrochemicals, which is what you've mentioned, and the fact that it makes sense to move up the hydrocarbon value chain, among other things. I think what we're seeing is a couple of things. Visions and strategies across the GCC, that a lot of them target sectors. And the issue with targeting sectors is they're targeting similar sectors. So you see, for example, every vision and strategy in the GCC is targeting, industry and manufacturing to move up the hydrocarbon value chain. A lot of them are targeting to be as a logistic hub. A lot of them are targeting tourism. A lot of them are targeting financial services. But there's a question of crowding. How many financial centers do you need in a small, geographical space? How many logistic centers, how many mega ports and mega airports do you need in this small geographical space? Tourism, are you cannibalizing on each other's tourists? So that's sort of the thing that you need to take into account, because you have to consider that everyone else is doing something similar or aiming to do something similar to what you're trying to do. So maybe you either have a first mover advantage, or you just need to think in terms of stuff that is unconventional and that's different from the other people are doing.
Interesting. Well, let's jump here to we're getting a whole bunch of questions from the audience, so please keep those coming. I am going to try and work them in, and then we'll go directly to your questions here in a second. I want to get to the other main topic of this webinar, though, and that's climate change, its effect on oil demand, and sort of the longer-term strategies around it. We've touched on it already. But the future of oil demand is looking increasingly uncertain, right? We're starting to hear this term radical uncertainty being thrown around. We've got these forecasts that are coming out. These, the BP outlook says that, it's possible oil demand plateaued last year, right? And then we've got the OPEC forecast that says no, 2040, right? So these used to see these forecasts kind of running in lockstep, and now they're kind of diverging pretty wildly. We've got the energy transition unfolding. Nobody's really certain at what speed. So how are the Gulf countries positioning themselves for this change? Tarek, I was wondering if you could kick us off on this.
Well, I think Ziad touched upon it earlier, that there has been an effort to diversify economies now for, over 20 years. In fact, maybe even longer than that. But I think really the pivotal point, certainly in Saudi Arabia, came in the late 90s when oil, as you know, went below $10, single-digit oil prices. That really concentrated the minds at the time and actually led directly to reforms in Saudi Arabia, which then ultimately allowed Saudi to join the WTO in 2005. So oil or low oil prices has really been a good way to, as I said, focus the minds. And certainly, we're refocusing again. If you look at Kuwait recently, there's been a lot of talk about the need for reform. But the problem, again, Ziad touched upon it, is that the hydrocarbon economies in the region share very similar characteristics in terms of their reliance on oil, their demographics, their geographies. And so trying to identify a path that is slightly differentiated from the others is really challenging. And in many ways, Dubai has eaten most other people's cake, if you like, in the sense that they've got an airline and a financial center and a port and tourism. And so if you're a Kuwait or you're in Oman or you're another country, identifying a niche or identifying a sector where you can be credible in growing and in employing people is getting increasingly difficult, and certainly difficult when you have a young population that aspires to maintain a standard of living that has been enjoyed by their parents. And so, there are some really critical decisions that policymakers need to make, and many of which thus far have not been made.
Tough decisions that, as you say, they seem to be, the UAE just seems to be out in front on taking these risks and making these decisions. We're seeing this, sort of establishing a relationship with Israel now as another one of these kind of risk risky steps that I wrote about some of this in my book about Dubai. Dubai established this diamond business and meant that it had to deal with Israel, and it was okay with that. And other countries in the region just weren't really ready to take that step yet. They were able to carve out this kind of unique economic niche in the region. So, Tarek, you mentioned in your note that we're seeing some pretty crazy valuations in the clean energy space, and that your fossil fuel company valuations have not been doing as well. Wondering if you could just maybe mention sovereign wealth funds in the Gulf and how they are positioning themselves. Or not, right, for the energy transition? Are they investing in what is the competitor for their basically their source of funds? And also, should they, during hard times like this, should they be investing at home, or are they really is that against their too much against their mandate?
Yeah, great questions, Jim. So on the first part, I can say definitively, because I've done a lot of work around this with sovereign wealth funds, is that they are massively underinvested in their competitors, if that's the way that you want to see it. Typically, they're taking money from hydrocarbon sources and they're reinvesting it in global equities, which are benchmarked to some degree into these companies. So a sovereign wealth fund typically will be invested in the Chevrons and Exxons and Shells, etc. But it's less likely to be invested in the likes of First Solar or Jinko Solar or some of these other companies that effectively are competitors. I think Saudi Arabia stands out a little bit as being slightly more aggressive in investing in. For example, they've taken a stake historically in Tesla, which unfortunately they sold, but they're still holders in solar power companies. They've got an investment in electric vehicle companies. So they're a little bit aggressive, but the sums involved, given the relative scale of the sovereign wealth fund, which is about $2 trillion in total AUM. So we're talking about very, very small percentages. So I think that's a problem. And as to the second question, I was very vocal a few months back about the need for sovereign wealth funds to be investing domestically, because there are plenty of opportunities for them to play a role in developing domestic industries. And even in terms of financing, the Sukuk market is getting quite deep and can absorb the types of monies that are available to sovereign wealth funds. And so it was difficult, frankly speaking, to witness the sovereigns making massive investments overseas back in March, April, and May, when there were clearly companies within the region that could have done with some of that financing. So I hope that gets redressed over the next few months and years.
Interesting. So I want to turn to some of the audience questions here that happen to dovetail with my next question anyway about economic diversification. And let me flip that to you, Ziad. We've gotten a few questions on this. One is, how do lower oil prices affect these aggressive economic diversification plans in the region? How has the coronavirus affected the? I guess that's the same question. The economic diversification, and maybe you could you give us a little bit of a stock taking on, especially the Vision 2030. Is there still a long way to go on that? Are the Saudis meeting? Have they met any of the goals of it? Are they are they making progress, etc.?
Sure. So on diversification plans and oil prices, I think the decline in oil prices, we always hear talks about diversification, but I think you only get the change when the backs are up against the wall. And I think you only saw the seriousness of the moves after 2014 when oil prices declined. Have we seen enough? Probably not. When oil prices declined, we're still seeing, fiscal reaction here. We're still seeing governments that are unable to provide support in the middle of possibly the deepest downturn on record in each of these countries. And if anything, they're withdrawing spending. So that's telling you that the economy is still beholden to oil. In terms of Vision 2030, so the vision was announced a few years ago. 2030 is obviously the destination, but along the way, 2020 was supposed to be sort of an intermediate point where a set of targets were set at the onset of the vision with the National Transformation Program for the year 2020. And we've been monitoring these. And I think it's fair to say, even before the pandemic hit, these targets looked basically out of reach. So if you look at targets that, some of the metrics that target the diversification of the economy, like the competitiveness ranking, like the foreign direct investment, like the now discredited World Bank's ease of doing business rank, they were all behind target. If you look at the labor market, you see mixed sort of success, where you're seeing high participation from women in the labor market, but you're also seeing the unemployment rate was not hitting where the authorities wanted to be, which is 9% of the Saudi labor force to be unemployed. And then if you look at the fiscal side, again, the picture is mixed. You're seeing definitely more disclosure from Saudi Arabia. The budget document is definitely more hefty. You've seen the introduction of VAT, but we haven't seen the increase in non-oil revenue that was targeted initially in 2016. So I think the fair thing to say is that even before the pandemic hit, these targets looked out of reach. The problem is that the pandemic came at an unfortunate moment. So it's a mixture of, the targets were, things were off track, but also the unfortunate timing of the pandemic that came in 2020 that made even targets that looked attainable probably completely out of reach.
Wow. So even so more broadly, it seems that these economic diversification away from oil, beyond oil, however you want to look at it, oil is a unique industry in that it provides these rents, these extraordinary profits. And when you diversify into something that's out, you're getting a much more competitive business. You're not going to get these rates of return that you're used to. So what is a petrostate to do? I mean, are they going to have to, we're going to see more taxes? Can we have a monarchy that in a diversified economy? I guess we have one in Dubai, so I guess it's possible. But it seems like it's going to be a much more creative and difficult a process.
Yes, and the difficulty also is this is a non-standard economic problem, and not just economic, as you mentioned, it's a political economic problem. So, for example, country X is going through a currency crisis, or country Y is going through a debt crisis. We have many episodes in the world of these crises. We know what needs to be done. These decisions might be politically difficult, but we know what the right policy menu is. Diversification away from a commodity is just a rare thing. It's very hard to think of many historical experiences where a country escaped such reliance on a commodity. So you don't even have, a set of policy menu to pick from and decide whether that's worth taking this policy X versus policy Y and what are the trade-offs of this. So I think that's the difficult part. But that's what we're seeing, basically non-standard solutions or non-standard proposals rather than solutions. So I think it's essential that you attract foreign direct investment. You need it to replace the lost trend from oil in terms of capital, but also you need it in terms of know-how. And we've seen proposals from many places, and I think there is some credibility to these, of introducing, changing the way that the oil revenue is being distributed. We're reading stuff about, universal income. Stephen Herzog has the LSC. Ali Al-Salim has discussed it for Kuwait. I think it definitely had merits for a country like Iraq, where you change the way that oil rents is distributed. Instead of distribution through public sector jobs, maybe you send a check to everyone. And if people want more, they have to do something productive to get it. So that way you are maintaining sort of that distribution of oil rent, but at the same time you're incentivizing people to drive productivity and try and push productivity, and that will hopefully help move away from oil.
So we've seen a bit of that in Saudi Arabia with their citizens account program, right?
Yeah, although that's more of a social safety net, so it's means tested, etc.
Okay.
It's not a universal type of income.
That's right. So let me start flipping you guys some questions here from the audience. There's some good ones. You had to be expecting this one, given that it's election season here in the U.S. Here's a question on impact on the oil price if Biden wins. Impact on the JCPOA. Any expectations for Biden to patch things up, either shorter or longer term, with Iran, and what that might do, what that says for oil prices in the Gulf and the Gulf, the status of the Gulf economies. Either one of you guys, Tarek, maybe if you have any thoughts.
Yes, well, I mean, I don't have an informed opinion about the JCPOA, but what I do think is that the Green New Deal is really a big deal for the region to think about and to consider. I think that climate change, although not sort of particularly popular in this part of the world, and perhaps not even in Texas, but in much of the world, there is almost unanimity in terms of, whether you're on the left or on the right, people seem to think that, combating climate change is a good thing. And shifting towards clean energy is also positive. And so that's going to be the single most significant impact of a potential Biden presidency, because I think, for whatever said about Trump's close relationship with the Middle East over the last 4 years, and it has been a close relationship. Generally speaking, in my opinion, we've had a fairly bipartisan approach towards the Middle East by the US, for decades essentially. And so the only major difference, I guess, from the current election outcome is going to rest on the central issue of the Green New Deal.
So, any thoughts from you, Ziad? Biden, how it might play out?
So much like Tarek, I'm probably geopolitical forecasts are probably not my area of expertise, but it just reminds us of something. Because we talk about oil at 40 and we talk about OPEC production cuts. But oil is sustained at 40 not because OPEC Plus has cut by 10 million barrels per day, but also because you had involuntary reduction in supply in some countries like Iran, like Venezuela, like Libya. And if these countries come back online, that's another downward pressure on oil. So we have sort of many risks that can push oil prices down. And I think regardless of when you think peak oil demand is, whether it happened last year or whether it's going to happen in 2040 or 2035, we know over the last 6 years, most GCC countries have been running deficits and they've been drawing down on their reserves. They've been accumulating debt. So even if you haven't reached peak oil yet, we know that the pressure on oil prices is quite strong, and we know that the balance sheet of GCC economies are eroding, and I think that's why you need some focus on real diversification and maybe think about difficult decisions to make.
Okay, all right, so here's another question from the audience on immigration, and maybe you guys could expand it to look at labor policies. Ziad, you had some data, and I think your first or second slide on labor issues, and this has been one of these bugbears that's been going on for a long time in the Gulf. We're seeing coronavirus, maybe an opportunity. There's been a shift of labor leaving the country. I think also some of the infections were in the labor camps as well. So, do you see any changes coming on immigration? Either more or less, or different types of visas?
Well, again, since 2014, there's been a push in a number of GCC countries to grant long-term residency to their citizens. So we've seen that in the UAE and Qatar and Saudi, thinking about the green card type of policy. I think we've seen some laws being implemented. We've seen some numbers, but the numbers are probably small. I think this is part of sort of the unusual problem that the GCC faces, which is basically not only you have this extraordinary reliance on a commodity that is hard to see in any other place, either over geography or over time, but also it's this reliance on foreign workers, where you have a large structure of the economy is basically populated by foreign workers. And I think that has obviously its own issues. But one of the issues, for example, in other countries, when you have a massive slump in the economy, you get high unemployment rate. In the GCC, you don't get that. What you get is that people leave because their stay is linked to the visa. And what that means is when you get a recovery in other countries, people have, they maintain their houses, they're in the same place. It's easy to reverse that unemployment process. Whereas in the GCC, it's much more difficult. Once people leave and depart, it's very hard to start. If demand picks up, it's very hard to, rehire them, bring them back in, and we're probably going to be different people. So that search process is much more costly here in the GCC than elsewhere, which means that even if you have the stimulus and if demand picks up, the return to normalcy will take longer than other countries.
All right, Tarek, did you want to weigh in on that, or can I?
Well, I mean, only to say one thing, and that is that although you have these cycles where people do leave, and I've seen it in Dubai on a couple of occasions where you go through a recession and people leave their cars at the airports and fly away, but it comes back, and I'm pretty sure it'll come back again. So it was pointed out to me recently that after the last financial crisis, after the global financial crisis, when people spoke badly of Dubai's prospects, the population back then was about 1.7 million, 90% of whom were expats. Today, the population is 3.5 million. Now, we'll go through a phase here, and there are some forecasts that Dubai may lose 900,000 people as a result of the coronavirus pandemic. But Dubai is looking to increase its population to 5 million by 2027. So longer term, if you can see through these cycles, these economies will get bigger as a function of their larger labor forces.
And apartments are looking like a pretty good deal in Dubai right now, as I noticed in your research note. It wasn't always the case.
Wasn't always the case.
So, one more question here from Mo Amr. I'm not sure if that's the comedian, Mo Amr, the Palestinian American comedian who I think lives here in Houston, but he's asking about the GCC break, the problems with Qatar and Kuwait and Oman, and this sort of new dynamic in the GCC that has these kind of camps of different countries taking different sides. Any thoughts on where that's going, and if any prospects for Qatar to rejoin the fold?
Again, it's something that is very hard to predict. We've seen, for example, talks between Saudi Arabia and Qatar at some point that ended up going nowhere. I think where, as far as the economy concerned, where this is very relevant is in the position of Oman. If you think about the most vulnerable GCC country from a financial perspective, it is probably Oman. We know that Bahrain is another one, but Bahrain has already got support from other three GCC countries. And what Bahrain enjoys is basically that Oman doesn't have, is that Bahrain is smaller and it's more politically aligned with Saudi Arabia and the United Arab Emirates. So the decision to support Bahrain is fairly straightforward. Oman is larger, is slightly more independent, and there's a question of how this regional geopolitics, and in the context of also the US elections, how that plays out if Oman ends up seeking financial help from the GCC. Will it be getting it or not? And I think that's something that is definitely worth watching.
Great. Tarek, did you want to weigh in on any of that? Or?
No, I mean, my only comment, I suppose, is that Arabic countries are making peace with Israel. So the prospects that Qatar will come back into the fold at some point is of course, clear and easy to predict.
Yeah, this Saudi boycott of Turkey is kind of making it into another strange new dynamic, right? Sort of a indirect pressure on the Qataris to I don't know, to rein themselves in or something. I don't know. Any thoughts on that before we get out of here?
Not from me. Ziad, you want to say something about Turkey?
No, not in terms of relationship with the Saudi. I think that's part of the regional sort of dynamics that we have, the three axes in the region, and they compete and at times talk to each other. So
yeah. All right, well, let's call it there. That's been an hour. It's been a fascinating discussion. I've loved it's great to see you guys again, and really appreciate you coming in on a Thursday evening when it's it's your weekend is kicking off and getting on with us to parse up some of these topics here and hear more about the Gulf. Hope you guys both stay healthy, and I'd like to thank our audience for coming on with so many great questions, and we'll play, we have a Center for Energy Studies has one of these webinars every week. We usually have it at a happy hour on Friday, but this time we're having it Middle East happy hour time. So given the time difference. So thanks for coming, everybody. Thanks, Ziad. Thanks, Tarek. And we'll see you guys soon.
Thank you very much.
Thank you, Jim. Thank you, Jim.